Hello everybody, welcome to another update on the Gold Forecaster Index, and I wish you a happy new year. And of course, you can't enjoy your wealth without a good health. So health is the most important. And so the Gold Forecaster Index has been really amazing. It has forecasted everything that I said, and it is really the holy grail. So everyone needs to watch this trend in the gold forecaster index and just follow it, and everything will be going great. So in my last video, I told everyone to buy gold, and that's somewhere here in beginning December. And lo and behold, gold has risen, I think like 10 to 20% here. And let's see what our new data point says. Should we now sell or should we buy even more? I don't know, but the gold forecaster index knows. Okay, so let's go here already. And the latest data point says that it's going down. So the trend is moving lower. It's still in the positive. So that means the positive momentum is still positive for gold, but the power is decreasing. So I would really be thinking to take profits now because maybe the next month this will go to zero. It's very possible that this will go to zero. So I would not be buying anymore at this point. Also because the gold price has risen so much, it will correct. And especially when the gold forecaster index is pointing lower, that is not a good sign. So that would be my recommendation for this month, to either hold or take profits. Now let's go to the different leading indicators and look where the problem is, because why is this going down? Let's look at this. First, let's look at the big picture. The leading indicators, what are they saying? Let's look at this blue line. That's the leading index. It is actually moving back up. So it went down here, but is now trending back up. Also, the red line, the coincident indicator, is also bottoming out. And even the OECD indicators are bottoming out. So well, here it isn't bottoming out, but I think there could be a rebound here when you look at the leading indicator. So the economy is actually not doing that bad, as I said before. Also here, recession indicator is not saying that we are in a recession. There's no sign of a recession. Okay. Also very important, I want to talk about the misery index. I wrote an article about that recently. So what is the misery index? That's unemployment rate plus inflation. And apparently we are at a multi-year low. So this is the misery index, the blue line, and it is at a, maybe this is an all-time low even when you look at this. And this means that the stock valuations, the PE ratios, I don't know if you can see this, but there's an inverse correlation between the misery index and the PE ratio. So if the misery index goes down, then the PE ratio, the PE valuation of stocks goes up. And we are now at 18, I think. And that means that stock valuations are going up, but the earnings are not going up. So yeah, this is the a rise in the stock market due to valuation metrics. But one day this misery index will finally move back up, And I think we are almost at that point now. So we will see unemployment go back up and also inflation go back up. I'll show you why this is. So first off, we have the leading indicator of productivity, and that's the blue line here. And productivity has been going down. This is a minus sign. So it has been going up here, so that means that productivity is going down. And that means that also the inflation, the consumer price inflation will normally move up with decreased productivity. And the latest data here says that there's an upwards trend here. So inflation should be going up. That's one evidence. Second evidence, we look at the producer price index. It's also moving higher. So the latest data point here in November shows an increase in the producer price index year over year. And maybe this could start a new trend here, a rising trend. So it could be that the consumer price index starts moving up again. The capacity utilization rate, we see the same here. The latest data point shows a rise in capacity utilization from 76.6 to 77.3. And I think that there's a high probability that this will continue rising with all this money printing, which will push up the PMI. And yeah, for the services and for the manufacturing. And this will add to the inflation pressure. So that's the inflation part. Also, the Taylor rule, that's a new indicator that I just discovered. So what's the Taylor rule? Well, it's actually a formula that that looks at the output, the potential output, and then there's some formula things on that, and it will say that there is a certain rate that the Fed needs to have to maintain inflation at at zero. And today that is a rate of 3%. That is the rate that Taylor uh, is telling us. And the Fed funds rate today is only 1.5%. So this is below the Taylor rule rate. And that means that, that there is inflationary pressure if you don't uh, go to the Taylor rule rate. Don't know if you understand it, but for example here, this blue line is the Taylor rule rate minus the Fed funds rate. That is, for example, today it's at 3% minus 1.5%. So that is 1.5%. That's this data point here. Yeah, 1.6 apparently. And if it's positive, that means that there is inflationary pressure. So this area here is all inflation. This area here in 1980 till 2000 is deflationary pressure. So in this period, gold is going down due to deflation. And in this area, there's inflation, so gold is going up. Same here. Here, the Taylor roll rate minus the Fed funds rate was positive, really positive here even in the 1970s, and then you saw the gold price move up. So today we are here in positive territory, so we should see inflationary pressures. Now let's move on to the unemployment rate, which I think will move up over the next few years. And I found here a very interesting correlation between delinquencies. So the blue line is the delinquency rate percentage change. And we see here that the blue line always goes first, and then the unemployment rate will follow. And this is the rate of change. Now we see lately in 2018 that the delinquencies are actually moving up. And I think that those delinquencies will keep moving up this year because we see a lot of downgrades and that will translate in high delinquencies. We also have a lot of corporate debt, so I expect that this trend moves up and unemployment rates will follow higher. This is the jobs chart, and the leading indicator here are the hires minus separations, which is the blue line here. And the latest data shows that we're going down. See this trend here? And I think that the latest, the last month non-farm payrolls, which were very outstanding, is just an aberration. I think that this red line will go down this month. Well, it should go down this month because the blue line is going down relentlessly here. So normally I would expect a bad jobs number. So the red line would go down and then the unemployment rate, which is the green line, will move up. So this will go down. And that's all within my forecast. Let's look at the balance sheet. Okay, so the Federal Reserve is now still doing these repo operations and buying of treasuries. Still moving up here. It's not going down as they said. And here you can see that they are buying treasuries since last year and they are selling mortgages. The red line are the mortgages. But overall, we see an increase in the total amount of the balance sheet. The repos, look at this, it has not gone down. So it keeps rising, rising, and rising. And now Chairman Powell is saying that that this will end by mid-January. So he has still 2 weeks to get this down, but I don't see it going down. So it could be that Chairman Powell is a bit too optimistic, or maybe even lying, but let's assume that he's telling the truth and that by mid-January this will start going down again. So normally Powell will not be buying any repos anymore. But that's not what we are seeing now. Let's look at this here. This is a detailed chart of all the repo buying. And the latest number here in January the 6th, yesterday, shows a huge increase in overnight repo buying from the Fed. So it's still not done yet. Still a lot of buying. And you can also see that commercial paper minus Fed funds rate is moving higher. So that means that there's stress in the banking system here. Banks do not want to borrow and loan each other money for the longer term, so the 3-month term. And that's a problem. Well, it has gone down a little bit, but the trend is still up. So we can monitor this. Let's look at the credit spreads, a very good leading indicator for stock market. And the blue line is, it was going up, but since since this year that it has gone down a little bit. Let's see what the trend will be. Could go down more and then stocks will crash or can go higher. What's also interesting to see is that since repo operations started, you can see that those corporate bond yields have moved down. So that's the buying of those corporate BBB rated bonds. And the same for the AAA ones. They are actually moving down, while the treasury yields, the green ones, are moving up. So this is moving up, and the mortgage rates are also moving up. The blue line is moving up. So what you're going to see here is actually a narrowing credit spread. So not widening, but narrowing. So the credit spread is, what is it? That is the AAA minus 10-year yield. And you see that it is narrowing here. And the same with this one here, the blue and the red line, it is narrowing, which is the blue line minus the red line. So you're seeing here that credit spreads are narrowing, and what does this mean? That this 10-year minus AAA is actually moving up, and that means that GDP will be going up. So there is an upwards pressure on GDP. And that's all because of this money printing by the Fed, repo buying, which is manipulating these credit spreads and moving GDP higher. That is what is happening now. And that's why the economy is actually doing better than I thought. Now we have another great data point here, just out, the trade balance. So the trade deficit, which is the red line here, is actually shrinking again. Look at that. The red line is actually shrinking here. So the trade deficit is improving. And that's also good for the dollar, which follows this trade deficit line. So we are going to see a strengthening dollar again when you look at this chart, which is of course not good for gold. But okay, this is only the trade deficit. We also need to take into account the budget deficit. That's also very important. And when we look at the budget deficit, and I have created this chart here, which is the trade deficit plus the budget deficit. And when you add them together, then you get the orange line here, and it is still going down. So if you add all the deficits together, then we are still trending down, which means that the dollar should be going down. So on one hand, let's give this this other chart here, the deficit chart here. Uh, then you can see that the budget deficit, which is this orange line, is actually increasing, going down here, while the trade deficit, the red line, is improving. So I think what is happening here is that the Federal Reserve is printing money, which increases the budget deficit, so the orange line going down, and this improves the trade deficit. So the trade deficit is going up. The same here. Orange line is going down, and the trade deficit shrinks. And typically this happens when there are recessions. So actually here in 2000 we had a recession, budget deficits went up, trade deficits went down. Same here, budget deficits went up, trade deficits went down. Same here, 2008, budget deficits went up, trade deficits went down. And now again, budget deficits will be going higher and higher. We will get more than $1 trillion in annual budget deficits. And probably this thing here will move higher, move up. So the trade deficits will go down. And this, if we have had this 3 times already, then I think the fourth time will also be a recession. So this is actually an omen that we will see a recession in the next few years. Also, unemployment rate going up, that would also tell me that a recession will come. And this is the evidence of that. Now, we also had the latest number of COFR, which is the currency composition in the world. And as you can see here, the US dollar is still at 62%. So people are still holding the dollar. The euro has been going down a little bit, and the Japanese yen is actually moving higher. So the trend is now that everyone is moving into the Japanese yen. And I've also written an article about Japan. They have just sent out a budget report, and it was actually a very good report. The tax revenues were going up, budget deficit was shrinking. So this is very good for the Japanese yen. Also, the stock market, the Nikkei, is just booming. So I think that's why a lot of people are now going into the Japanese yen. Okay, let's go over some of the blog posts here very quickly. Yeah, this one. So apparently gold is going up while the amount of negative yielding debt is going down. So that's a discrepancy here. What does it mean? I don't know. Maybe gold will go down or there's a regime change. Because the only way that this can happen is that there is inflation. Okay? Because when you look at this, negative yielding debt going down means that interest rates are going up. And so you see gold going up when interest rates are going up. Okay, that is a very normal regime because bonds are deflation assets and gold is an inflation asset. So when bonds crash, which is actually happening now, then gold will win, which is this trend up. And that's because when there's inflation, then bonds go down and bond yields go up. Okay, so just think about that, okay? Yeah, recently we had this major escalation here in Iran, and I recommend to buy some Russian oil stocks. So instead of buying gold this time, just buy some Russian oil stocks. There's a high probability that oil will go higher, and Russian stocks have a 6% dividend, very high earnings. So I think that's a better idea at this point than to buy gold. I've talked about this. They are still buying repos. So Mark Faber video here. This is also interesting here. We see that the silver inventory at the Shanghai Future Exchange is still going up. So somehow the Chinese are stockpiling silver, buying silver, and normally the silver price should move higher as well. Let's take this one. So this is the SDR, and you can see here that we have a bottom here. So since the new year, the SDR gold price has been moving higher. So gold is actually moving higher against all currencies. That's what this means. Let's see. Yeah, I've talked about this. That's the the deficits here, and dollar will go down in the long run. Also, this is a very funny video from Mark Faber, and he says that he is going into platinum, and I also agree with that. Platinum is very cheap. Uh, let's uh, let's show the chart here. So platinum is now at below 1000, and I think this is bottoming out. The trend will be higher in the coming years. So platinum is at 1000. Gold is, where is gold? Gold is at 1600 now. So here, somewhere here. And whereas palladium is at 2000. So we have the price of palladium twice the price of platinum. This is just completely insane and unsustainable. We will see platinum go back up one day. So that's also what Mark Faber thinks. He's going to buy platinum. I also talked about Bank of China. Okay, the loans are defaulting there. There's a high risk of loan defaults, but China is going to do everything to make sure that the banks don't fail. They are going to bail out every Chinese bank, and Bank of China will be doing well. It will stay at this price level. You will get a lot of dividends here with a PE ratio of only 5. So this is a good investment because China will never let these banks fail. You can also go into the Singapore real estate. You can look at these charts. I think that Ascendas will be going higher with a 5% dividend, and the dividend will also keep increasing each year. Um, Vacancy rates are going to go back down, so that's all good. Rents are going to go up even. That's all good for the Singapore real estate market. Next blog post. Um, some information on silver supply and demand. So fabrication demand has been going up, um, and supply has been going down recently. So this is actually very important. Maybe we have seen the top here in silver supply. If this keeps going down and the mines keep producing less silver, then I think silver can can shoot up on a higher demand. You can see here that new mine supply is declining. There is not a lot of scrap silver at $17. And also the government silver inventories are at record lows, so they cannot supply some more silver from here. So I think silver should be going higher. Also some interesting charts from Willem Middelkoop. You can see here the supply and demand numbers from several metals. For example, nickel. Nickel is, look at it, we are here somewhere. Supply is lower than demand. That's why the nickel price has been going up. So that's nickel. Zinc, the same. Supply will be going down while demand goes up. Palladium, the same. Supply is lower than demand. Platinum, very interesting, is that this is not that good. Demand is here higher than supply, but here the supply is actually higher than demand. So in 2020, 2019, platinum is not doing that well because there's too much supply out there. But when we go to the future, then apparently Willem Middelkoop says that demand will go back higher than supply. And that's when platinum will shoot up. Copper, look at this. Supply is just crashing here. We are now in 2020. Supply is going to crash while the demand is going higher. So the copper price should be going higher. And also, just a comment on this. You know what the byproduct is from copper and zinc? That's silver. So we are going to see here that the supply of copper is going down, which means the supply of silver will be going down. And the same here for the zinc. Zinc supply is going down, which means that silver supply is going to go down. And that means there's only one way for silver to go, and that's up. Some comment on this here, the permanent portfolio. I hope you all know what this is. So there are 4 assets here: gold, cash, stocks, and bonds. And everyone should have at least some of each of these assets. I know a lot of people are only in cash. They just put their money in the bank, and that's the worst thing that you can do. They say they are not investing, they want to be safe, but cash is also an investment. That's the thing that they forget. And when you look at this quadrant here, you have on the left you have gold, gold, which is inflationary. So gold is inflationary, and the opposite of that are bonds. Bonds are deflationary. So the opposite of gold is bonds. And when you look at these upper and lower quadrants, you see stocks and you see cash here. Stocks should be bought when there is growth. And when there is a recession, you should go into cash. Cash is king in a recession. So use this quadrant and look and see in which phase are we now. We are now in an inflationary phase. Look at the Taylor rule. We are inflationary, so you should be here. And do we see growth? Yes, I see growth. GDP is still positive. Leading indicators are positive. So we are in inflationary growth now. So you should be in stocks and gold. And both have been going up. So this is a very good way to allocate your assets. Go into gold and stocks and put a little bit less in cash and bonds. But you should have all of these assets. What do we have more? So the Federal Reserve had an FOMC meeting, and you can see here that the dot plot, the interest rate projections have actually gone down. Every projection has gone down here, gone down the same. And that means that the Federal Reserve is not going to increase rates, it's going to maybe decrease rates or at least hold it steady. It's now at 1.5%, and Powell has said that he will not increase interest rates before he sees persistent above 2% inflation. So what does this mean? Think about this. That means that the interest rate will be 1.5 and inflation will be higher than 2%. So that means that we have negative real rates. They will keep being negative. So that's a very good environment for gold. And you can see that here gold spiked up when the FOMC meeting uh, ended here. Comment about Japanese bonds. I saw that Japanese bonds went up very high here. Not sure why, but it went up more than the US bonds and the German bonds. Next, some info on the Perth Mint gold sales. They are picking up in the latest months, so that's a good sign. And here I want to show you the discrepancy between palladium and platinum. Platinum has gone down with 50% since 2010, and palladium has gone up 300%. So this gap will probably not fill, but at least you can play this. You can go into platinum. Let's see this. I think we're done here. This was the last video. So you know what to do. I would not be buying gold at this moment. Try to go into the oil stocks, Russian oil stocks, because there's a probability, of course, that oil will go higher on the Iran tensions. And just listen to the gold forecast index. It is going a bit lower, so we could get a correction here. And I'll see you next month. Bye.